We're thrilled to be here, and Chris, thanks again for the partnership with MGB, you and your team. What you've pulled off again this year with this forum is incredible, and we're really happy to be partnering with you on this mission. So thank you very much. I know this portion of the program is titled The Global Economic Outlook, but we can't talk global, Brian, before talking about what's happening here in the U.S., and you obviously have a great lens on to what's happening in the U.S. economy from your seat, CEO seat at Bank of America. A lot of cross currents, right? Consumer spending appears to be holding up, but we have tariffs. How sticky is inflation going to be? Is the Fed going to cut rates? What are you seeing from your seat and for the rest of this year and as we think about 2026?
Well, thanks, Miceal, and thanks, Chris. And Dan and the team, it's always great to partner for this great conference. And thank all of you for coming and sharing your thoughts and ideas. And hopefully you're getting, in return for that, a chance to make connections and learn more about other people's business models and important issues relative to the health field and innovation. So as we look across, for the U.S. specifically, we have the U.S. growing about 1.5% this year, a little faster next year, and a little faster than that the year following year. So if you think about that, that is below trend growth. And that projection of growth came down due to all the things that we're all feeling in our businesses between the uncertainty of tariffs and things like that. But you got to flip it on its head and say it is growing. And that is different than a lot of places in the world, which makes the U.S. a strong economy. It's the largest economy. It's growing about 3/4 of its trend rate, where other economies are growing much less than their trend rate. And that's the setup for this year. If you look beneath that, a couple key points. One is the consumer continues to spend, and those of you who would have seen a flash come up today from the various financial networks, the consumer spending for the month of August came out stronger than people thought. We knew that was going to happen because in our data, we saw that the August movement of money by consumers in the economy was up over 5.5%, almost 6% versus last August. And we've seen it so far in September to be 5% type of number. So the consumers actually picked up their activity despite what you read out there. That always bodes well because the U.S. economy is about 2/3 driven by the activities of the consumer. Now, if you look on the flip side, companies are trying to figure out all the things, and we can talk about tariffs and other things. But on the other hand, they're making money. The credit quality is good. They have access to capital. The capital markets are open better now than they were a few months ago, and hopefully that trend continues. And when you put that all together, that's a decent backdrop for the U.S. heading into it. But remember that those growth assumptions that are on the table now, if you were sitting here last year, this time into the fall, are probably 100 basis points lower than they would have been back then. So there was a projected recovery this year, which is being pushed out a little bit due to all the activity that you're seeing out there.
So let's dive into some of the risks in terms of what would cause growth rates to slow in the U.S. here. Are you worried about, we've seen some data around jobs starting to slow, especially at the lower end of the income spectrum. What are some of the things that you're keeping your finger on the pulse on as you look at the economy?
Well, so as our team looks at it, and you've seen some of our research team, Tim, in the session before, it's one of the best in the world. As they look at it, there's a couple of things going on. The trade tariffs are a particular risk for certain industries. But importantly, the employment situation in the U.S. is we're at full employment at a low 4s unemployment rate. With the change of policies on immigration that the administration has put in, that is creating potentially a supply-side labor problem. And that's one of the things that people are trying to figure out how this works through. So you have this oddity that you need labor because your economy is growing, and then labor slowdown coming in the country for a lot of job categories. And the U.S. population without immigration basically doesn't grow. It grows very slightly positive. And many of you in the fields that know this, the demographics of the U.S. without immigration are actually flattish growth rates. And so if you sort of think about that dynamic without immigration, where do you get the people to do the job? So that's one of the things that's a real risk. And we'll see how that balances out as we move through time. And the other risks are obviously a slowdown in consumer confidence that plays into their behavior. And what you've seen so far is a change in their confidence that has not played in their behavior. So people are really worried about what was going to happen next to them. Would they be booking cruises at a much higher rate this year than last year? The answer is probably not. Would they be going out to dinner more this year than they did last year? The answer is probably not. So while there's stress among median income households, that you can't deny, and we got to keep figuring out ways to help them participate in the economy. That stress is not an overall economic issue because of the dominance of the spending by the median income households and above and how that drives the economy.
Is there any worry as you look at consumer or corporate balance sheets as it relates to stress around debt payments or leverage? Is there any signs of that yet that you've seen from the data?
We haven't seen it yet. Big rumors. Commercial real estate had a change by the behavior of all of us as employers that is largely through the system, meaning that our occupancy rates of buildings changed dramatically. After the pandemic, we learned we could operate in a different mode. That's, if you think if it's 1 day a week, that's 20% less real estate you need for the same capacity. If it's 2 days a week, that's 2/5 or 40%, and 40% is a big change. And so, even with people on hybrid schedules and stuff, so that was really a credit discussion that went through largely through the system and completely absorbable. But if you look on the consumer side, credit card delinquencies in the prime categories are below where they were in 19, or around the same, which was a normal, kind of solid economy. So, and then on the commercial side, other than commercial real estate, the credit quality and the credit availability is strong, both in the capital markets for larger companies and also off of bank balance sheets. And commercial loan growth is faster than deposit growth in the industry, which is an unusual event because usually deposits grow faster than loans across the industry, and loans are growing faster, which means there's some demand out there. The problem is the demand's soft relative to the use of lines and stuff, so that's causing some overall growth rates, but the demand is solid.
So the Fed convenes for their September meeting tomorrow. The market is anticipating almost universally a cut tomorrow of 25 basis points. Can you talk about how you're thinking about the Fed and rate cuts as we look into the back end of this year and into 26?
So the market has a 100% chance of a cut announced tomorrow afternoon. And so our team in our research group came to that sort of reluctantly, and that's because inflation is still high. And inflation is basically probably kicked back up a little bit due to all the activities going on. And so our team really had no cuts until literally 2 weeks ago. They finally caved in and said, you know what, because the labor markets bounce around, they'll cut rates. But the idea of a cut or two is not the important thing. As you look out and hear from the Fed tomorrow on what their long-term projection is for Fed funds rate, what they call the dot plot, not to be tedious, but and if you look at that, you're gonna probably see that doesn't change a lot. The long-term Fed funds rate, they're talking about 3% levels, and so if a cut comes earlier, we had a lot of cuts next year, bring it down to that level. All we're doing is pulling them forward in our research team. But the thing to fundamentally remember is that the rate structure of a 3% Fed funds rate and a 4 to 4.5% 10-year rate is more normal in U.S. history, in world history, than what a lot of us have what we've all lived through for the last 15, 17 years. That's the unusual time. And so one of the adjustments going on in society is for people who were 16 in 2005, who are now 36, facing a whole different set of questions about housing and all that stuff. Guess what? They think that a 3% mortgage is what standard mortgage rates are. And if I took a survey here for people who said, I got my first mortgage, the 3% and under would be none of you, unless you got it in the last few years. The 6% and above would be a lot of you. And so that long-term rate structure is actually healthier dynamic for the United States, a little faster inflation, a little long-term growth, because the Fed has to keep the inflation down, and right now the inflation is running still a little higher than their target. That's going to be the tug of war the Fed has, especially if other factors, labor and others, contribute to inflation. So keep your eyes tuned to that, but don't take tomorrow's cut versus December cut as being anything meaningful. If they change their tune of how far they think they have to bring down rates to get equilibrium in the economy, we should be worried, because a low rate structure is actually not a healthy place for this economy to be. And just go look at Japan and you can see what the impacts of that is. So probably what it reflects is going on, not the impacts. It reflects the economy.
Probably a good segue, as you mentioned, Japan, to widen the lens to global expectations and global growth. What are you seeing in terms of global growth, in terms of the different regions of the world? What's our expectation around global growth this year and next year? And then maybe some areas of the globe that you think are interesting in terms of from a growth perspective versus others.
So if you think around the world, it just focused on 26 because we're almost done with 25. But in 26, we have Europe growing at just a little under 1%. We have Japan growing about 0.5%, India growing a little over 6%, and China growing about 4.5%. If you sort of think through what that's really saying when our team looks at it, they're basically saying that Europe still isn't back to a reasonable growth rate for it, that the dynamics in Europe still keep it below 1%, which means their central bank and others are going to have to keep fighting this sort of very low growth, very low rate environment and trying to work it through. If you think what it means in China, China usually grows at 6%, so there's pressure on China because of all the dynamics going on. If you think of what it says to India, it says India's growing at 6% plus, which is strong for an economy which has been growing and increasing its size. But they've taken about 100 basis points off that growth rate due to some of the dynamics of the trade and work going on. So their prediction is India grows, but grows at a slower rate than predicted. And with Japan, if I was in Japan, we've been in Japan since the day after World War II ended. We were the first person to extend loans on behalf of, asked by General MacArthur to get the Japanese economy going. So we've been there since they came out of World War II. We're there to celebrate that duration. And there's a lot of enthusiasm earlier this year that Japan was going to kick into gear and be out of it, and yet the dynamics have settled back in. So 0.5% is a little bit of it's a growth rate which is not unusual for Japan to look at, but it's against the expectation. It would have been more. And again, the impacts of trade and tariffs around the world on these countries that supply the sizable economy, U.S., is where you see the rubber meet the road a bit.
So when you think about tariffs and some of the rhetoric coming out of Washington, you travel the globe. What are other leaders around, outside of the U.S. thinking of us currently, and how receptive are they to business from the U.S. with what's currently happening?
So when I travel, because of our name, obviously Bank of America, and because of what the company I have the honor of leading, I get asked to explain how this all works, and that's kind of the question I get asked often.
We're going to need more time for that. I think, yeah.
And there's four policies that the immigration policy, the tax policy, the tariff and trade policy, and then deregulation, that the administration was very clear. We're going to do it in this order, and we're going to go after it this way, and this is what we're going to do. And I think people outside the U.S. took a little while to believe that was true. They basically said they can't be serious and all this stuff, and then now they know they are. So I think, a lot of times it's saying, this is how they're coming at it as best I can tell you from my discussions and listening and watching it and thinking about it. So you've got to adjust to that. So I think what you're seeing with the tariffs is, if you think about it, two parts. One is country level, and then second is sort of sector. But in a country level, you're seeing sort of goalpost on the table. On the left-hand side, sort of a 10-15% level, which is the base tariff level, and on the right-hand side, it's 30, 35, 40% if you're Switzerland, where I was a few weeks ago. And you end up between those goalposts. Based on sort of what you're willing to do in buys and removing non-tariff barriers and things to balance the purchase power of the two companies. We buy more from you, you buy less from us. What can you buy to close it down? And as you close it down, the tariff moves to the left goalpost. But I think it's clear. I don't think there's any mystery left. You've seen enough deals announced. UK, and the president's going there for the state visit tomorrow. Korea, there's enough. Japan, there's enough outlines of deals that you can discern that, except in the case of China and maybe Canada and Mexico because of the next year redo of the USMC. But you're seeing those deals fall into place. So my advice to countries is, you're in that range. Now you've got to decide where you want to be, and that's going to be on your commitments to invest in the United States and or buy from the United States, and rebalance that balance and imbalance in that we buy more from you than you buy from us. And there's a laundry list of things, and have at it. The second thing is non-tariff barriers. That's much more subtle, but is something this administration, the president is clearly after with Secretary Lutnick and Secretary Besant, because as they've heard from companies over the years, the size of seatbelts is different in Europe than is here, and we think a little bit wider or whichever. And you're saying, is that really a difference that makes a difference? Because then you have to retrofit every car. And so there's a lot of debates about countries of origin and ways things work that are non-tariff barriers, both on the regulatory side, approval of drugs and things like that, the processes can be a barrier to entry. And so they're working on that, which is good for American businesses. But I think the outlines of this is set. Now, when you get to sector-based, and because of the business that all you are engaged in, pharma and sector-based and some of the tech, that's still out there going around, but the country-based activity is settling in.
Yeah, and when you think about, let's dive into healthcare since that's why everybody's here today. Give us your thoughts in terms of some of the challenges and opportunities in healthcare. We've talked about AI. There's been a lot of really interesting panels in terms of next generation technology and what that brings to healthcare. How are you thinking about it as a bank in terms of how we support this ecosystem, and what are some top things on your list that you're focused on?
So I think we can think, when I think of this, I come at it different things. I chair a board of a university that has a research hospital attached to it that's going through all of the fun stuff on research dollars. I run a company that spends $2.3 billion on healthcare costs a year, self-insured, so major buyer. I go at it thinking about the debt, which is a major issue for the United States, the impact on debt for Medicare, Medicaid expenses, and how that all plays into this. And then I go back and think about it, that all you think about it, my discussions with Ann and others at Mass General, the impact of technology is not different for you than it was in our industry in the past, over the past series of years, and what will be in the future, not only on every aspect of it. So, I'd say starting with the last one, technology. If you think about, as I learned about a lot of the companies here, we had a group for dinner last night talking to you and traveling around, the world talking to companies. The combination of, we were, talking to a nonprofit last night about a nonprofit last night that delivers eye care through vans and things like that. The idea of that being possible a decade ago, the idea of delivery of these capabilities. So there's a whole delivery structure, which is not unlike our industry, which changed dramatically how we delivered banking services to all of you. Then there's the research capabilities and AI enablement and finding the needle in the haystack and finding these interesting things. That's a huge impact. And then there's the advances in computer science, computer capacity, around coupled with biology and chemistry and physics and all that coming together. So it's just a fantastic time. But maybe the piece, Miceal, I can sort of think about. If you look at our company from 2010 to now, so 15, 16 years, we had 300,000 people, we have 212,000 people today. So think of that impact. That was all through, and the company's bigger, much more transactions, much more stuff happening, many more reports filed, you pick your things. But what happened was the ability to digitize work driven by the customer changing their behavior. So the advent of the app-driven devices, starting with the iPhone, how that permeated society, how people got comfortable with that, and how people got comfortable with conducting their business is a huge change that is affected our company, so that we ended up with 80,000, 90,000 less people doing a lot more work. And so you have to think about that as you start to turn to a new technology which changes the course in a different part of the company. So in that world, our teammates that worked in operations went from 50,000 to 25,000. Our teammates who worked in the consumer business in the numbers of branches went from 100,000 to about 55,000. So think about those changes. But if you start to take those two numbers out, you say, where else happened? Well, in that time, we went from about 2,000 or 3,000 people in risk to 8,500 people in risk. So what AI does is allow you to go to different jobs and different capabilities. And so thinking about the basic of a model is to take information, put it through a brain, and have it come out the other side. That's what the 200,000 plus talented teammates we have, the 2,000 plus kids we just took out of schools around the country, 400 schools to come work for us have, et cetera, et cetera. And yet now it's interesting because you can touch it. And so that element is wholly different that we're all facing in business. And the way we manage that, I think it's got to be critical. The human side of it's actually the most important side of it, getting people to use it effectively, how we do it. We're seeing great impacts. Erica, that has had 3 billion interactions with customers 200 intents or questions it could answer to 700 questions. You took the technology of coding technology, read about 18,000 coders using, save 10-15% of their time. These are massive changes. So I think if you think about that technology change, there's analogs here, but where it can go is wholly different. And then management's job is to manage through it carefully. So all during that time that we went down 90,000 people, we accomplished it through attrition and people, for whatever reason people left. We didn't hire people to replace them, knowing that in a couple of years we may not need them. And then taking people who worked in one area and retraining for other areas. That's the management challenge here, because our teammates have got to help us do this and participate in it. And so it'll be interesting to see how, whether our teammates and ourselves can manage it, because we have to the tune of a lot. So I think as a technology one, I think is one. When I go to the research piece, I think all of us have to advocate for research. I've worked with the Council on Competitiveness, I worked in universities, I've worked with a lot of colleagues. In the end of the day, the fundamental research that you all do, some of you do it in private industry, some of you created companies, some of you are in large companies, but a lot of it starts with Mass General and the primary investigators in Mass General and all these other places, generating just pure research to figure out a question. And then we can commercialize it. What makes the United States unique is that we take that research and commercialize it. And I think we've got to really advocate for that. And I know you had Susan Collins here yesterday, who's a big advocate here, but we've got to make sure NIH funding, related fundings and NASA and other stuff stay there. And there can always be changes and always be prioritization. That's gone on for years, but the basic idea is that is so critical. And so, all of you are connected to these enterprises and connected into Washington. We just have to be advocate, because it's a competitive advantage for the United States. And so the panel you heard before, and our clients, the stories we hear, and last night with a group of 5 clients, 3 of them had come from outside the country, saw the opportunity here to commercialize a research capability and brought it and have companies, and you're saying this is what makes it all work. So help us advocate for that. And I think that's that risk is out there. So those are a couple of things I think about.
Yeah, maybe adding on to that, you mentioned the commercialization of research, and you think about that journey from a startup all the way to getting a drug out there. For us and capital markets, you mentioned capital markets, they're starting to flow again. Yeah. What's your vision in terms of the opportunity? Because it was tough sledding there for a bit in the capital markets. What's your outlook as we look into the end of this year and next year in capital markets?
If you think probably this year versus last year, the IPO market, there's more prospects to get these companies out. I think there was a big private capital market. It got clogged up a little bit. The public markets are one of the ways you unclog that market, and I think it's happening. So I think, leave aside the focus on AI and activities, there's a broader market, and I think our teammates have a huge pipeline of IPOs, and in this field and others that I think are there. And companies will get out there and companies will be successful and some won't be successful. That's the nature of the beast. But I think for the first time in a good time here, I think people look at it saying they can fundamentally see it. Actually, I was thinking back to the last conversation and the GLP question, and so I was on my way over and I asked I did a calculation. I said, maybe I'm right, maybe I'm wrong, so let me check it. We will spend in 25, 9% of our entire healthcare budget on GLP-1s. So from nothing 5 years ago to almost 200 million. So our interest in getting the benefits out of that, and some of the dialogue on the panel before, is acute. And I think that goes to, frankly, the surety, the revenue stream that actually helps. That's a particular drug which is already commercialized. But if you think about the assuredness of revenue stream for some of these innovations is going to be by purchasers like us. We have 600,000 people we insure. We are extremely generous in what we cover and why. But at some point, we've got to make sure there's value coming out the other side. So between the docs, between the producers, the manufacturers, and the research, and we do a lot of interesting stuff in the more innovative care for our teammates that are sick and trying to help them any way we can. But I think there's a basic economic question there too, which I'd forgotten to mention before when he said challenges. So the challenge is, can we get the value out of it, knowing that the value may come 20 years down the road. And that's the hard thing. So you have to convince us it's so good, and we have to convince ourselves, and not that we're not convinced, but we have to stay convinced, so we assure the revenue streams, which then feed back into the capitalization to get you out and stuff like that. So it'll be interesting to see it play out, but it's gone from really nothing to that number and had tremendous impacts. Now we got to make sure those impacts stick to the ribs and provide downstream benefit. And that was kind of the conversation between Tim and the colleague from Italy before.
Yeah. So we had the governor open up day 2 this morning. She talked a lot about the ecosystem here in the greater Boston area of Massachusetts and how proud she is of that with all the great companies and researchers at hospitals, universities. Talk a little bit about, you travel across the country and you also are part of the Mass Competitive Partnership, which is a group of some of the largest employers here that really care about this region. Can you talk about the challenges that you see in Massachusetts and balance that with the opportunities to bring more companies to do business here in Massachusetts?
20 years ago, probably, maybe not that, 15 years ago, I was sitting next to Ted Kennedy at a lunch where we were both doing something. And, I'd just come out of Phoenix, and I said, you should see what's going on there, because we stood in the building in downtown Phoenix and we looked down, and that's before they moved the medical school there, and he just saw this huge patch of real estate that they were going to basically dedicate to research and medical innovation off the backs of the work that had gone on the genome and stuff like that. So I think as you think about the amount of effort and money and talent that you all represent, is expanding. And the opportunities are expanding because of new techniques and new innovations and the Genome Project and all the ramifications off of that, which I can admire from a distance. But what I tell you is different is Nashville. We go to Nashville, you go to San Diego, obviously Austin and Silicon Valley, and you start going around, and Orlando with the complexes they built, Phoenix with the complexes they built. You say, across the United States as an enterprise, we're drawing talent in, and across the United States, this region is, a big beneficiary of all the work that goes on and talent we have here. But it's a lot more competitive now. And so when I talked to the governor and talked to her, I said, you got to be careful, because what we have here, which is really fun, unique, and interesting, has to be coddled and assured, because there's a lot of places out there that are making the same pitch, and it's pretty wild when you start to see what they're doing. So I spend a lot of time in Charlotte. Obviously, our company's headquartered there. Gene Woods' company, they just are putting, to Gene's credit, $1 billion in the ground, and they're putting up research labs, and I took a tour of them the other day. So you start to think. So one of the things I try to say to our Massachusetts colleagues, because I live here, and this place is important to me. I've been here since I was more or less 17 years old in the Northeast, and in the end of the day, we have to make sure we're competitive. How's that competitive? Regulation, taxation, incentives, real estate availability, hubs, all the things that the governor and everybody recognize. But we had a wild card, a curveball thrown at us with the research funding debate and everything that we got to work on. But infrastructure, the talent here, the Mass General platform, and all it represents, and its colleague platforms that exist in Boston and down to Providence and out to Worcester, it's incredible. But the competition is different than over the last 2 decades, and that's what's kind of interesting. So my ask to the governors, you got to nurture this. Or else it can find a home. That might not have been true 20 years ago, but it's more true now. So we can't take it for granted. It's a powerful engine. It creates a lot of economic activity. It's been the growth engine in some ways of what we are here. You travel the world, somebody's seriously sick, they show up here. It's highly respected. But it's not as unique as it once was, and that's the care we got to take about it from a pure Massachusetts hometown view. But from a global view, when you go around all these other places, see the capital formation, incentives, there's a lot of activity going on, and it's good stuff.
That's great. So tell us a little bit about what else you do when you're not focused on driving responsible growth at Bank of America. I mean, there's a lot of, whether it be the regulatory environment, working out, whatever, not just that, but just what do you do in terms of keeping, where's your attention? Because you got a lot on your plate. I'd love for the audience to hear a day in the life of Brian.
Always reminds me of the old adage. There was a coach at Brown when I was going there. He used to say, half of you go over here, half of you go over there, and half of you go over here. And that's the day. So we try to. Look, I have a great family and a great spouse and great kids and a first grandchild, and that's all fun. I try to spend as much time on that. But outside of the day-to-day business, efforts like this are critically important to me because I can see what you do. So we've worked for several years at Mass General on this with Chris and Ann and Miceal and Larry DeRita and trying to think of ways we can make this more interesting and important. Meanwhile, I spend a lot of time in the Council of Competitiveness, which is all the great research universities, the national labs, where I learned a lot about the incredibly things that research does across the platform, and then I try to take that knowledge and work it. So I take care of my family. I go to the dump like all of you do. I play a little golf here and there. I do this stuff work out, try to stay in shape, and then I spend a lot of time reading and stuff that is probably not my wheelhouse, and I try to spend my spare time on stuff I think I can have an impact in. So Brown University, I've been heavily involved there, the National Museum of African American History and Culture, because that museum is a statement about our history and an important story to be told, the work here. And so I try to figure out things where I think our company or me individually can have an impact and give them the benefits of what we can do. And and then I bring resources and talent like you and your colleagues to help drive it.
Great. Maybe touch a bit, because it impacts healthcare in a major way too, but the financial service sector, the regulatory environment is always front and center. A lot of discussion that this administration is going to lessen some of the regulations and be more pro-growth, which we're starting to see. Can you talk about whether it be financial services and healthcare and how you envision the regulatory landscape evolving here in the next few years?
So I think one of the explicit decisions by the administration, having had 4 years to think about how to go after their next administration, and a lot of people working on them, was to go about their activities in a different order. So the first Trump administration, they went deregulation, tax, and then trade. So they did it in that order. This administration, they flipped it because they said we got to get trade and tax done because that provides a benchmark. So the debt in the U.S. is a serious issue that we've got to deal with. The operating budget, those of you in research growth mode with no revenue are probably doing financially better on an average basis than the U.S. government, which is running a third deficit on its operating costs a year. And so it's operating a platform a year. So the way to do that was to use the tariffs to potentially raise money and create more activity in the United States, grow the pie, then use taxes to make sure the U.S. companies and other companies found investments here, and then get to the other aspects. And so immigration and deregulation, and immigration has been going on. So deregulation, I still think is this turn in the track for administrations we head in this fall and beyond, not only in our industry, but I think all industries. So I think it's a time to be active in terms of trying to get the balance right. So a lot of the work on deregulation is more stop doing X, Y, or Z. It was sort of stopping activity, which the administration thought was harmful to the ability of the United States to grow. I think now you're going to see a more structural change in how they're going to work it. And so I think one of the things was to change the people operating the bureaucracy in Washington, D.C. relative to industries, and that was the purpose of changing out heads of departments, which always happens, but also shaking it deeper. I think that's happened, and I think that now it's how do we write rules that will balance the overregulation back to a reasonable place, but also write them in a way that they'll stick to the ribs and be part of the regime going forward and can't be just pulled away. And so that's different. I think the area of pure Healthcare has some interesting aspects to it that all of you know better than me, but I think we as buyers of your services, you as providers of services and provider of the innovation in those services, I think have to make sure that in that deregulation we actually come up with solutions that keep the United States being the place to innovate for healthcare. Yes, we spend a lot on healthcare. Yes, we get a great service out of that. Yes, we're the envy of the world. Yes, the world depends on us to do that or else there'd be real issues. That balance and that understanding is an interesting question, and how do we get paid back by the rest of the world for that, honestly, is an interesting question to the administration. And then what can they do to change the return question is another interesting question. So I think in the regulation, all those areas are under wraps, and then, you know, like Ann and hospital operators have to deal with near-term issues about Medicaid coverage and things like that. But in a longer term, it's a chance to have a serious discussion about competitiveness for the U.S. Architecture in every industry and how it has benefited the world, and are we getting it in a position where it will benefit the United States and the world both, not or, but and. And I think that's what they're looking for ideas on. So I'd bring your ideas, but I think you have to start from tariff, tax, and then deregulation, which is opposite. So, you know, now's the time. Even though you've seen some activities, it's more about EOs and stopping stuff. Now they've got to actually make the stuff. So the idea of doing only quarterly, semi-annual reports for public companies got put on the table this week. That takes a whole SEC process to get through it. A cost-benefits analysis, a new rule, and I don't know if it takes congressional. So that will take time, but if you do it right, it sticks to the ribs afterwards. If you don't do it right, the next administration comes in and just changes it. So they're trying to work carefully on that. So our job as industry, across all these industries, to support them.
Maybe we'll ask one more question. Early in your CEO tenure, you implemented a strategy called responsible growth, and we've been living the responsible growth mantra here at Bank of America now for more than 10 years. Can you tell the audience a little bit about your thought process and what responsible growth means for Bank of America and how we operate the company?
Yeah, at the end of the day, we have to grow because that means people like what we do. So you have to grow, no excuses. You have to do it with the right risk so that you can grow in any environment. And then you have to do it in a way that's sustainable, which means we have to be the best place for teammates to work because we are a talent company, and that goes back to our medical coverage and how we do that. We have to share our success with our communities because if they're successful, we're successful, and that's our charity work and our energy transition work and all the work. And then we have to drive operational excellence to pay for it. And so the three pillars of being sustainable is people, our communities, and ultimately you have to pay for it. And the way you pay for it is by keeping the cost structure in line so you can actually deliver for the shareholder. And I think it was really a view of how we had to operate the company. Think of us coming out of the financial crisis with a brand that needed to be reconditioned, with an operational platform, having done 6 major deals and putting it together. And that was done. But it couldn't be an excuse not to grow, and that's why we measure, that's why you have to grow no excuses and win in the market and those types of things. I think if you back up from it, I think that the great debate about how to do capitalism and capitalism right and stuff, what we've stood for as a company is doing capitalism right way. So doing on a balanced basis to benefit you, our customers, our teammates, our communities, and our shareholders. Because at the end of the day, a financial services company is a prospect of the community. So that is the way that responsible growth actually is a mantra inside, is that balance and how we do it. And I think all of us have to keep that going, because at the end of the day, if we don't do a business in a way that benefits those constituencies, there's a challenge of whether people think it's the right business system. And the U.S. business system, and U.S. style capitalism, is the only business system that actually works out there. So, if you think U.S. and Europe, if you close your eyes and sit there and say, in 2005, 2006, Europe was going to overtake the U.S. by now. It's not close because of the capitalistic system we run. And we belly flop sometimes, and we do a great job sometimes, but it's that resilience, that ability to fund the companies, and some of them don't work, and off we go. And then how we adjust and how we have a deep capital market. So I think doing capitalism right feeds into responsive growth, feeds in how we try to approach the business. And then, and all of the things are equally balanced. Being a great place for teammates to work means that we're willing to spend that money on GLP-1 so people have a better health position for they and their families. That is critically important, because that then drives down our turnover and drives up our loyalty and drives up our ability to do a great job for the clients. So it's all tied together.
Well, Brian, thank you for your leadership of our company and all you do to help the state of Massachusetts, and we really appreciate you being our keynote speaker here today. Thank you, Brian.
So thank you. Thank you.